Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 22nd of September. I'm Daniel Lam, your host for the podcast. Being a derivative strategist by training, I've always been following the moves in VIX, the short-term volatility index of the S&P 500. After Liberation Day, the VIX index has pulled back sharply, and we've been in a low volatility environment for the last few months. Macro weaknesses is a key factor that can drive volatility higher. The last couple of US non-farm payroll numbers, they've been weak, and there were negative revisions. Now, if we regress the key factors, such as leading growth expectations, where we are at the business cycle, sentiment, and risk, as well as variations against the past performances in S&P 500 index, we can see that the probability of a 10 to 20% drawdown over a 3 to 12 month horizon is around 25 to 30%. That is not alarmingly high, but it is certainly not trivial either. As a result, implied volatility has been bid up. Currently, the VIX is trading expensive versus the realized or the actual volatility of the S&P 500 index. There has been a sharp surge in the volume on VIX exchange-traded products over the last few months. Now, looking at the micro front, there has been zero growth outside the top 10 US stocks in forward net income over the last 3 years. The mega cap technology stocks are still driving the performances in S&P 500. So is this good or is this bad? Well, if the prospects for these mega cap stocks deteriorate, then this over-concentration can hurt. But the earnings have been strong and forward guidance exciting. In fact, in the most recent earnings season, the magnitude of positive earnings move was the largest versus negative moves over the last 2 years. So this should floor any sell-offs in equities. The secular trend in AI, as well as the deregulation in US banks, should drive technology and financial sectors higher. Now, interestingly, despite the prowess in these two sectors, the current performance versus S&P 500 is actually just around the average level over the last 10 years. So going forward, we can expect these two sectors to pick up more in their outperformances, leading to more dispersion or differentiation in performances across the sectors. These moves can cancel each other out on an index level, leading to lower index vol in general. Overall, we believe the markets can be a little bit volatile over the next 4 to 6 weeks because the FOMC last week did not surprise the markets and cut by 25 basis points. After the sharp move higher, risky assets may experience mild pullback. We will be using such opportunities to add to risky assets, such as Asia ex-Japan equities, US tech shares, as well as bonds of 5 to 7 years of duration. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.